Thank you for joining this webinar on market driver-based forecasting. My name is Stijn Rutjes. I'm a senior business consultant at EyeOn. And in this webinar, I would like to introduce you to the approach that we take when we would like to set up a market driver-based forecasting model. And this is typically a technique that you use to create a long-term forecast at a more aggregated level in a market environment which is quite volatile, where you're in an upturn or in a downturn. I would like to determine when you're going to be in an upturn or into a downturn. I will start with giving you a short introduction of the concept of market driver-based forecasting, and then we will use a specific customer case to show the approach and also the results that we achieved via this customer case when setting up a market driver-based forecasting model. And at the end of the session, I will answer you the question that you raised during the webinar presentation. Now, why do you need a long-term forecast? There are a lot of different questions that came out of various disciplines in a company. For instance, one of the questions might be, how can I determine my long-term forecast so that I can take decisions on my capacity in terms of investment or divestment in capacity and set up certain capex decisions. Another example could be that you would like to support the marketing and sales department in showing how the overall market is going to develop, and based on that they can define their market approach. And finally, another very typical question is the question coming from the financial environment, and where financial people are interested in to determine an accurate and reliable financial plan, also for a more long-term horizon. And when you look into the different ways of forecasting, you can distinguish at the one hand between objective and subjective forecasting and non-causal and causal forecasting. When you look into objective forecasting, this is the forecast where you use facts, historical data, or indeed market drivers to define a statistical forecast. On the other hand, you have the subjective forecasting where you use the information coming from marketing and sales or an expert panel to determine your demand into the future. Now, on the other hand, you can distinguish between non-causal and causal. The non-causal time series model are the classical model where you just use your historical data to determine forecast. Well, as the causal model, you will use the historical data, and in addition to that, you'll use certain market drivers that have an impact on your demand and that are taking along in your forecasting model. To just give a number of examples, for instance, when you would have this demand profile, it's rather stable. So in this case, you probably are able to just use a simple time series model to create a statistical forecast. And when you look into a sales development like this, it's much more erratic. But if you take a second look, you can distinguish a certain pattern. You see a recurring pattern coming back in year one, for instance, and in year two. So in this case, you also can still use a time series model, but then apply a seasonality technique to it. Now, when it comes interesting, it's when you look into sales patterns like this, where you see a sudden drop and then a peak again in sales. So this is where you really would like to understand and anticipate, look forward on what is going to cause the dip and then the peak in my demand. So this is where you really would like to use a market driver-based forecasting model. If you take a second look at this sales history, imagine that this sales history is the sales of ice creams. Well, the sales of ice creams is probably going to be affected by the temperature. When there's a good temperature, sunny weather, the sales of ice will be higher than when the temperature is low. So in this case, temperature will be a market leading driver for the sales of ice cream. So the model will consist of the historical data of ice cream as a reference, and in addition to that, we would add in temperature as the market driver to predict the sales. Now, there are a lot of different indicators on the market, freely available, that tell you something about the development of any industry. They are freely available, freely accessible, but companies often have difficulties to really determine those indicators that really have a predictive value for their specific market and their specific business, and also have an understanding on, in case my market driver will go up, how long will it take before it has a specific impact on my business. So this is where the market driver based forecasting model will help you to identify that and set up a proper model. Now let me go to the customer case and the starting point of our customer case, starting with some of the characteristics of the company. The company that we did this assignment for is operating in the building industry. They are producing insulation materials for different applications. They have a turnover of 1.8 billion euros. They have a lot of different sales channels, a big number of factories across the globe. But for the assignment that we took here, we really focused on the Benelux market, so the Belgian market and Dutch market, including also the Luxembourg market. We look into the supply chain of this company. They are producing high volume products, and as a result of that, it's very costly to store those products. So they are, in the majority of the business, in a make-to-order situation and a make-to-order replenishment strategy. And therefore, it's really important to understand how the demand is developing and how that will utilize the different production assets that they have long-term, so a couple of quarters into the future. And it's very important for them to achieve a high utilization rate in order to make profit. So there was a need to define a number of market drivers, leading indicators that give an idea on how their demand is going to develop. And they would like to have a decision support tool that will allow them to, in an effective and efficient way, to take these decisions based on a long-term forecast. And the specific deliverables of the project have been to define the market drivers and also define those ones that have a predictive value, set up the market driver based forecasting model, whereas this model should also allow for different scenarios, so changing some of the input parameters to see how the market will develop. And at the end, it should be embedded in a very simple and pragmatic tool so that it can be used in their demand planning processes. And when you look into the demand planning process of the company, you can distinguish between the short-term and the long-term forecast. And the short-term forecast, there they can use quite some facts in their system, like the order book, like confirmations of projects that were already granted to the company, and potential projects that have a high probability to be granted to the company. They can use that data for their short-term forecast. When you look into the horizons of 6 to 20 months, there they have difficulties to use that data to tell something about the future, because their demand is very erratic, is impacted a lot by the economical situation and the consumer confidence. So that's the reason that they were interested to set up a model like that. Let me take a look into them and explain to you how we approach this assignment. So it started by agreeing on some basic requirements of the demand planning process. And one of the first thing is to agree on the required aggregation level. And in order to do that, we looked into the different markets and looked into how those markets are developing and what is determining development of the market. So therefore, at the end, we decided to split up the market into residential building, so private houses, and non-residential building, which are typically warehouses, utility buildings, and where they use a different type of insulation material. On the other hand, we also distinguish between the Dutch market and the Belgian market, because the environment and the companies operating in those markets are very much different. So also the dynamic in the market is different. We decided to choose a time horizon of 5 quarters because they are using this model in their budgeting process, which is starting in quarter 3. So they would like to have a forecast then of a quarter 4 and then the next year, which takes up to 5 quarters. And we at the end agreed as square meters as the unit of measure to set up the model. And when you take a look into the approach, where we started with is to determine the potential indicators that should be used in the model. After that, we collected the data and we did some cleaning of the data that I will explain in more detail in a couple of slides later. We will use that data then to test the potential long list of indicators and come up with a short list of indicators that we're going to put into the model and see how we can set up a most accurate forecasting model, which is then step 5. We will test that model in step 6, and at the end we of course need to embed the model and the way of working into their existing demand planning process. When determining the potential indicators, it starts with interviewing a lot of different disciplines in the organization. Typically sales, marketing, product development to have an idea on what is the developments going on in the market and how they look into the future. And after it's good to also include supply chain as they have quite a good understanding of the market as well from their discipline. And you might want to add some additional disciplines to it as well. At the end, the conclusions of the interviews have been discussed in the workshop, and in a workshop we agreed on the indicators, the long list of indicators to use, and also on the definition of those indicators. Before we can start testing the different potential indicators, the long list of indicators, you need to look to your data and look into the raw data that you get from the company. And the first step in cleaning the data is to deseasonalize the data. We are interested in the trend of a certain market, and we would like to take out the noise which is generated because of the seasonality. So we first take out the seasonality, deseasonalize the demand, and at the end, by the way, when the forecast is made, we will seasonalize the data again, so that you have a good forecast that does at the end take in consideration seasonality. Going back to the data cleaning, the next step after the deseasonalizing is the outlier correction. This is where you take out some specific outliers that might have been caused because of different market incidents like political situation that caused a sudden drop of demand, which is not expected to happen into the future. And the last step is where you detrend your demand. What you see when you look into macroeconomic drivers is that they often all go up. In the current circumstances, maybe not, but for a longer period of time you see that a lot of those indicators go up. And you don't want to take the conclusion based on that there is a dependency because two indicators both go up. You are much more interested in whether a change in one of the indicators will also result in a change from one quarter to another quarter for another indicator. That's why you need to apply a detrending technique to make sure that you identify the true change of an indicator and apply that to your market development. So after those steps, we have a set of data that is ready to be used in the statistical analysis. Well, after the analysis, we get together with the same number of people, so sales, marketing, product development, and supply chain, and we feed back the results of the testing. So what we've been doing then, we ran the long list of indicators through a number of statistical tests, and based on that we have identified which market drivers are not significant and which are significant, and they are making up then the short list of market drivers. And you have to understand that this can be an intuitive process, an iterative process, because some of the results might be counterintuitive to some people, and that can be because of the reason that it is just the fact. So the understanding is different from the reality. It can also be possible that the definition of a certain um, indicator was wrong and that you would like to re-evaluate the definition and then run an additional test to those indicators. Well, at the end, this step will result in a framework where you plot the different indicators. And in this case, we identified a number of leading indicators which are having an effect on the overall economy. And next to that, there are a number of indicators which have an effect on the construction market in total as such. And then at the end, we identify a number of indicators which have a specific impact on the two markets that we identify. So the construction market and the residential construction market and the non-residential construction market. Well, we have agreed now on the short list of indicators, so we're now going to set up the model. And what we do is that we add every time one of the indicators on the short list, and we look into whether the adding that additional indicator does have a positive effect on the forecast accuracy. It can be possible that even though an indicator is significant, that in the combination of a number of indicators, it doesn't add to the forecast accuracy. So you add a number of those indicators to the model to set up the model. And often you come up with a model which consists of 3 to 4 indicators. You don't want to make the model too complicated, and practice and reality and experience shows that 3 to 4 indicators is the most optimal number of indicators to use in a model. And also here, it's often good to have some checkpoints with the business to determine whether the model makes sense, because there are some typical indicators that you would always like to add to a model. In this case, we knew that the number of building permits would be and should be a very dominant indicator in the model, and you for sure would like to have that in the model, also because that is something that the company wanted to use in setting up different demand scenarios. So there is also in this stage, it is good to have some checkpoints with sales and marketing. Now, building up the model, you see different buckets. You see the forecast which is generated for the next quarter, the second quarter, the third, fourth, and the fifth quarter. And when we would just take one example, again, the residential permits, for instance, those have a time lag of 2 quarters. What does that mean? That means that when permits are going up today, they have an effect on the market in, like, say, 2 quarters. That means also that if you would like to use and to set a forecast for quarter 3, 4, or 5, you cannot use residential permits anymore, and you need to look into different market drivers to still make a forecast for those remaining quarters. And that's why you see that depending on the quarter for which you make the forecast, a different set of drivers is used. Now, going into the model and defining the model, the approach that we took here is to use an out-of-sample validation test. That means that you take a set of historical data, which is in this chart represented by the gray line, and you define a certain horizon that you use to fit the model, which is the horizon where you see the black dotted line, and there is an out-of-sample data set that you use to validate the model. And in this case, this is the starting point in generating a forecast for the next quarter. And in this case, we didn't apply any or didn't add any market driver. So this is just a time series model. And what you immediately see that in a time series model, there is a lag, there's a delay in the forecast versus the actuals. You see that there's a 1/4 delay between the gray line and when the model is actually going to react. And this is what you would like to improve. So by adding an additional variable, in this case consumption, the consumption index, you see that already the gray and the black dotted line are much more overlapping. And at the end, for this particular model, for 1/4 ahead, we came up with 2 variables, and you see that this actually shows a quite accurate picture on um, the historical data versus what the model did achieve here. When you look into a forecast for 3/4 into the future, you see that a just simple time series model in this case will have a big delay, and you see that the difference between the gray and the dotted black line is quite big. So specifically for a long-term forecast, you see the added value of using this time series model. To use the market driver model. And in this case, we came to the conclusion that the most optimal model, generating a most accurate forecast, is a model where we added those 3 variables over here. And you see then that also for this forecast on 3/4 into the future, still a reasonable good forecast is achieved. And you can see that because the red line and the gray line over here are quite overlapping. Well, at the end, of course, need to embed the model into the organization, and in this case, the organization already had a quite mature demand planning process, which consists of a process at an OpCo unit, operational company unit, the regional roll-up, and then the roll-up of the forecast to the division level. And where they use at the moment this model is in their monthly forecast, so it's a reference towards sales in generating a monthly forecast. They use it towards marketing to support them in their marketing plans to set their pricing policy. And they use it also in their quarterly financial forecast. This 5 quarters horizon forecast is the input of their financial forecast. Where you cannot use it is in the forecast for more short term, where you would like to make up your supply planning based on a detailed forecast, because the aggregation level of the forecast is too high. Now, when we would have decided to go to a lower aggregation level, the noise of the demand at the lower aggregation level would be too big to be able to identify future trends. So that's why in these kind of models you typically would like to have a more aggregated forecast so you can determine trends and move away from the noise. Well, at the end, the model was built into a quite simple and pragmatic Excel tool, which allows the company to look into the leading market drivers in the chart, show how the model is proposing a forecast. It also allows them to do some scenario planning, so they are able to modify some of the input drivers and see what's the impact on their market. And they have the possibility to make some adjustments to the output of the model, because you typically see that statistical forecast is giving a proposal, and that you might still want to adjust for some elements which are not considered by the statistical model. For instance, the impact of changing legislation on the specific market. So that's why there's the possibility to make some adjustments to the output of the model. What you see here in this picture is the forecast of the specific market of this company. There is also a second step where we translate this to the specific sales of the company, so not so much the market, but the sales of the company themselves. But that's something that we cannot share in this presentation. But there is a second step where there is a translation to the sales volumes of the company. Now, Results that we achieved were quite impressive. So this picture over here shows the forecast accuracy that was achieved, and then looking into the accuracy of the sales of the company versus reality, so not the market but the sales of the company. And you see that specifically in the first 4 quarters, the accuracy specifically for non-residential was really good. You see that we have some difficulties to achieve the same accuracy for quarter 4 and 5 for the residential market. But then again, the model does allow the company to at least understand how the market is developing and also have an idea on the bandwidth in which the quarter 4 and quarter 5 market will look like, and that will allow them to, based on that, do some sensitivity analysis on what is the impact on their capacity. Well, the overall learnings of the project. First of all, the model has helped the company to understand their market. There has always been an assumption that there was a link between the residential and the non-residential market, or in other words, the utility market. And what you actually see is that the model has proven that. So what in reality happens is that when the non-residential market is decreasing, construction companies tend to focus then on the residential market, and as a result of that, the development of the non-residential market had a predictive value for the residential market, and we proved that via the model. Another thing is that we saw that there is a big difference in how the market in Belgium versus in the Netherlands is developing. The market in the Netherlands is very much dominated by big players, whereas the Belgian markets consist of smaller companies, whereby a certain family hires a smaller construction company to build their house. And as a result, in the Belgian model, the consumer confidence is a very important market driver in the model. Another thing is that they managed to move away from gut feeling to a fact-based forecasting model. They had the possibilities to create different demand scenarios, and it's a very good starting point in the budget discussions and also in how to approach their market. Now, when to use a market driver-based forecasting model? Well, typically in those areas where you're looking for a reliable forecast, for a long-term forecast, on a more aggregated level in a market which is quite volatile and has a lot of upturns and downturns, and we're really interested in when are we going to be in an upturn again and when can we expect a downturn again. Now, some other examples are using data coming from the German Maut. Because the German Maut, there is a lot of data available concerning the truck movements, and that truck movement data can be used to give an indication on how the market on trucks or the market on tires is developing. And another example is the example of the connection between the steel price and the coating or the paint market. You see that paint is being applied in a lot of cases on a metal surface. So when you look into the steel price development, which tells something about the development of the steel as such, it has a predictive value on the coating or in the paint industry. And last example is the example of the impact of feedstock pricing, oil pricing on the plastic market. So depending on how price is developing, also the market of plastics is developing. So that's another example on how you could use a market driver-based forecasting model. Well, in reality, every market is influenced by a range of leading market drivers. So in any market, you should be able to identify those drivers and model those drivers so that you can have a forecasting model which allows you to look into the future and do some demand planning scenarios. Well, this is the end of the webinar presentation. It's now time to answer the questions that you just raised during the presentation.